Welcome back. We're going to talk about discontinuing a segment or a product. As we work through a business and business has gone on for a while, sometimes a product, a department, branch, territory segment, any other type of subset may be generating losses. So when that happens, management needs to consider whether or not to discontinue or eliminate that specific product segment, branch, territory, etc. Discontinuation usually eliminates all of that product's or segment's variable costs, obviously, such as direct materials, direct labor, and variable factory overhead, and any sales commissions that may be attached to the product. But those fixed costs, depreciation, insurance, property taxes, they might not be eliminated by discontinuing the product. And this is where a lot of managers actually make a mistake. They don't take into account that a great degree of the fixed costs may remain. So it's possible that for total company income to decrease rather than increase if an unprofitable segment or product is discontinued. And this is because those fixed costs then have to be serviced by all the remaining revenues. Here we have the condensed income statement, and you notice that we have it broken down into products: cornflakes, toasted oats, and bran flakes. First glance, we see total loss from operations on bran flakes of $11,000. Uh, so, what a lot of managers in practice do is that this is what they look at and this is where they stop. Oh, it lost $11,000. Let's stop making it. That can have absolutely a negative impact on the overall company. Keep in mind, looking here, the company has $69,000 in total income after absorbing that $11,000 loss for bran flakes. So we engage in a differential analysis, and we have to make the determination of whether to continue bran flakes or discontinue bran flakes. So we're looking only at the information from bran flakes, right? They had revenues of 100,000, variable costs of 85, fixed costs of 26, creating their total loss of 11,000. If we discontinue them, there would be no revenue and no variable expenses associated with those products. However, the $26,000 of fixed expenses, fixed costs would remain. So we would have a $26,000 loss. If we were to carry this all the way over into our differential analysis, instead of an $11,000 loss, if we left things the way they were, we would have an additional 15,000. We would have a $15,000 loss if we were to make the decision to discontinue bran flakes because we would have to cover the $26,000 worth of fixed expenses that are actually being partially covered currently by manufacturing and selling bran flakes. So I will go ahead and go to this particular exercise for you and give you a little bit of time here to read this and digest this information. And then in about 2 minutes, we'll go over to the next slide. Now, remember, this is whether we continue to create a product or we discontinue it. And while we assume the fixed costs are unaffected by the decision, sometimes that is not the case. So now we're going to actually look at how this plays out. Here we have the differential analysis on whether to continue or discontinue and what that difference is. As you can see, of course, we would not have the revenues, we would not have the variable expenses. However, we made the assumption the fixed expenses, fixed costs would not be impacted. So, therefore, in this specific case, discontinuing product K results in an additional $3,000 that might be lost. We are not going to, uh, well, instead of losing $22,000, we will lose $25,000. So in this case, it's definitely better to continue producing product K because it is at least contributing partially to fixed costs that would otherwise be unaffected. Now, a lot of companies also have to determine whether or not uh, the products that make up the components that are assembled into their finished products, let's think automobile manufacturers, whether they should actually make that part or purchase it from a supplier. Um, Again, we will use differential analysis to determine whether to make or buy a part. So, an automobile manufacturer has been purchasing instrument panels for $240 a unit. The factory currently operates at 80% of capacity, and no major increase in production is expected in the near future. The cost per unit of manufacturing an instrument panel internally is estimated to have these specific costs: direct materials of 80, direct labor of 80, variable factory overhead of 52, fixed factory overhead of 68, and a total cost per unit of $280. Now, this one's a little bit different because we have to determine make or buy. We have our purchase price that's in there. If we purchase it, then that is $240 leaving the company. So that's a negative $240. That is $240 that we would lose. Now we have our direct materials, our direct labor, and our variable factory overhead. These we would incur if we make them. However, if we buy them, then that's a positive impact to our income. The key here is your fixed factory overhead because the assumption is that is going to exist in either situation. So because fixed factory overhead is going to exist in either situation, it is under both buy and make. If we were to buy the panels, then it would, in essence, result in $28 of additional cash flows out than it would if we were to make it. Now we're going to look here at a company that manufactures a subcomponent of an assembly for $80 per unit. It has $25 of fixed costs. There's a proposal to purchase the subcomponent from an outside source for $60 per unit, plus $5 per unit in freight. I'm going to go ahead and do a differential analysis on this, assuming fixed costs are unaffected by the decision. So here you see where we have, if we make the component, their variable costs of $55, fixed factory overhead of $25. So it would cost us $80. If we buy it, we have to pay $60 to purchase it. We have to pay $5 in freight, and that $25 of fixed factory overhead continues to exist, resulting in an overall cash flow of $90 out. Therefore, if we were to buy the component, it would cost us an additional $10 per unit versus making it. I imagine you've kind of seen that there's a little bit of a trend going on here. It's the fixed costs, the fixed factory overhead that are really the component that people tend to forget. So it's very important as you move on in your careers and on in your education, you keep in mind that a lot of times those fixed elements remain regardless of which decision you make. And if you reduce revenues, then some revenues from somewhere else have to cover that. Now we're looking at whether or not to replace equipment. Quite often, the usefulness can decrease before it's actually completely worn out. It may not be as efficient as new equipment. With changes in technology, we see rapid increases in efficiency, and something that we currently have may not be as efficient as something we could buy. So then we're in a position of determining whether or not to replace that asset, such as equipment or machinery, with a newer version. This type of analysis is going to typically focus on the costs of continuing to use the old equipment versus replacing the equipment. Remember, book value of the old equipment is a sunk cost, so it is an irrelevant part of our decision making. So look at November 28th of the current year. Business is considering replacing an old machine with a new machine. Here we have all the applicable data, the estimated annual variable manufacturing costs, selling prices, remaining useful life, and any residual value on the new machine, as well as the purchase prices of the new machine and the book value of the old machine. So, on a continue with or to replace the old equipment. Uh, if we replace the old equipment, we're going to sell that piece of machinery. So, if we sell that piece of machinery, we are going to receive $25,000 for it. We will have to pay $250,000 for the new machine. So you'll see that is a negative to cash flow. We have the variable costs related to each year or to each machine over 5 years because we're looking at a 5-year time span. And therefore, the total costs associated under each alternative. Income or loss related to each alternative is 1.1 million of a loss underneath the old machine and 975,000 of a loss underneath the new machine. Therefore, when we come over to our differential effect on income, if we were to replace the machine, we would actually have $150,000 of increased income that we would be able to capture. Now, this is because the variable costs, the variable manufacturing costs, which are going to include a variety of things, for the old machine is so much higher than the new machine that between that and the proceeds from the sale of the old machine, we more than make up for the purchase price of the new machine. The revenue that's foregone from an alternative use of an asset, such as cash, this is called opportunity cost. So, this is something that we give up. And although opportunity cost is not recorded in our accounting records because it hasn't happened, uh, it is useful to take into account when we're looking at the different courses of action. Here we have the example exercise on replacing equipment. Just give you a couple minutes, minute and a half here to read this specific situation and the information so you're familiar when we pop over to the differential analysis. You'll notice that the new machine in this situation reduces our annual direct labor costs from 33,000 to 11 to 22,000. There is an $11,000 difference in those variable costs by utilizing a different machine. Here we have the differential analysis. Now remember, we're looking at uh, $10,000 if we sell the machine, $45,000 when we purchase the new one. Now let's look at the direct labor from one to the other. Current direct labor costs are 132,000. They would only be 88,000 with the new machine. So, therefore, between the $10,000 proceeds from the old machine, the $44,000 worth of savings in direct labor from the new machine, we more than wipe out and yield additional income over the next 4 years by replacing the machine with a more efficient one. Now, keep in mind that these types of decisions, such as replacing equipment, whatnot, and therefore all come down right at this point in differential analysis to the bottom line. When you're making decisions like this, in reality, it's not just the bottom line that has to be taken into consideration. Sometimes you're going to take into consideration whether or not, as an organization, you want to uh, have to lay off people. Is that one of the things that you are comfortable doing? You may not be. If you are not, then you may not choose to replace the equipment, although you would receive $9,000 in additional income over 4 years. Sometimes, one of the things that you'll start learning about in different business classes is the triple bottom line. Uh, Here in accounting, we really focus on profit. That's why we look at total income or loss. But that is not the only decision making factor for management in today's day and age. There is also people and planet. So, although we teach you how to do these, this is only to give you one element of your decision making process. There are other factors that come into play as well. Now, here's yet another differential analysis decision that we commonly have. It's to process or sell. So, now often during manufacturing, there's a product that goes through different stages or processes. In some cases, it can be sold at an intermediate stage, or it can be processed further and then sold. I don't know which one we're using, but let's stop and think for a minute here about manufacturing tables. Now you can manufacture tables, you can sell at different stages of that process. Maybe you decide to sell it as a raw good. So it's not finished, there's no stain on it, there is no polyurethane on it, or you take it all the way to the finished, pretty, perfect condition. You can sell in either situation. Where do you decide to cut that off? We can use a differential analysis to determine that, whether or not we should sell at an intermediate stage or determine to process it all the way to the end. So, in looking at this, the differential revenues and costs from further processing have to be compared, and the costs of producing the intermediate product do not change. In either situation, we're going to have the same costs up to that point. So we're going to actually use a company that produces kerosene as an intermediate product. Um, and it can be processed further to yield gasoline. We have batch size, costs, selling prices, and for both of these. So let's look at the differential analysis. Now, if we were to sell kerosene, we would have $10,000 of revenue come in. We would have costs of 2,400, yielding 7,600 on kerosene. If we chose to process this further, take it into gasoline, we would have 11,200 in revenues, 3,050 in costs, giving us 8,150 in additional revenues. So therefore, taking it all the way to gasoline, even with an evaporation consideration, we would have $550 of additional revenue to process this further. This is our example exercise for process or sell. We're going to look at product T is produced for 250 per gallon. and can be sold without any other additional processing for 3.50 per gallon. Or we can engage further and continue to process this product and create product V, which can be sold for an additional, well, which would have an additional total cost associated with it of 70 cents. Product V can be sold for $4 per gallon. So we're going to prepare a differential analysis on whether or not to sell product T or continue to process it and sell it as product V. So here we have the revenues per unit of each. 3.50 for T, $4 for V. We have the cost per unit of 2.50 for T and then 3.20 for V. That is the 2.50 because we would have to process it up to T, and then the additional 70 cents that it would require to process it all the way to V. We would have income from T of $1 per unit and income from V of 80 cents per unit. Therefore, differentially, if we were to continue to process, we would have a 20 cents per unit loss by bringing it all the way to product V. Now, this next decision, whether or not to accept business at a special price, is one that sometimes comes into play. So, for example, a company can be offered the opportunity to sell its products at prices that are not normal for it. An exporter may offer to sell their products overseas at special discounts. We have to use differential analysis to decide whether to accept business at a special price. The differential revenue from accepting the additional business is compared to the differential costs of producing and delivering the product to the customer. Those differential costs of accepting additional business are going to depend on whether or not the company is operating at less than capacity. If the company is operating at less than full capacity, so they have room, then the additional production is not going to increase any of those fixed manufacturing costs. But there could be some selling administrative expenses that may change because of this additional business. We're using Bebo Incorporated, who manufactures basketballs. They have a monthly productive capacity of 12,500, with current sales at 10,000 basketballs. So you'll see there's capacity in there. There is 2,500 worth of monthly capacity. Now, their selling price here domestically is $30 per basketball. They have variable costs of $12.50 per basketball, $7.50 in fixed costs, so an overall cost of $20 per basketball. Now, they received an offer from an exporter to purchase 5,000 basketballs at $18 each. They have 3 months that they can spread their production over, and that's not going to interfere with their normal production, nor is it going to result in any overtime expenses. And pricing policies in the domestic market are not going to be affected because they are going overseas, so that's not going to cause them to have to reduce their current prices. So to reject the order or to accept the order. If we reject the order, we would have no additional costs and we would have no additional revenues. However, if we accept it, we have $90,000 worth of revenues. That's the 5,000 times $18 a piece. We would incur 62,500 of additional variable manufacturing costs. You're looking at variable manufacturing overhead, direct materials, direct labor. And that is the 5,000 units times the 1250. So there would be income of 27,500 additional if we were to accept the offer. Keep in mind, this is because we do not have to invest anymore in fixed assets. So that is not a driver at this situation. Now, your special business is accepted even though those sales are only at a price of 18, which is less than the manufacturing cost of 20, because we're not impacting those fixed costs by making this decision. They're staying the same. So because they're going to stay the same underneath either situation, uh, we would omit them from the analysis. Here we have the example exercise on whether to accept business at a special price. Let's take a second to look at product D, which is normally sold for $4.40 a unit. We have an offer to sell it at $3.60 for the export market. Variable production cost of $3 per unit. There is an additional export tariff of 10% of revenue that must be paid for all export products. So there's not a free trade agreement in place with this particular uh, country that it would be going to. We assume there's going to be sufficient capacity, so we're not going to have any overtime or additional fixed expenses that we would incur. We're going to prepare a differential analysis on whether to accept or reject this specific special order. So, again, if we were to reject it, nothing would change. We would not have more costs, we would not have more revenues. We would maintain status quo. If we accept the order, then that is $3.60 per unit. We know there are $3 worth of variable manufacturing costs. We would incur an additional 36 cents a unit in the export tariff, which gives us total costs of $3.36, and then 24 cents of income per unit. So we would accept this specific offer. Now we'll go ahead and break here because then we're going to move into setting normal products selling prices. And that's just different enough that we'll wait and start that in the next lecture.